While we may live in relatively peaceful times, it's often easy to forget that conflicts and tensions still exist in many parts of the world, whether it's in the Middle East, Eastern Europe, or even here in Asia itself, many of which could easily spiral out of control into larger conflicts, potentially dragging the rest of the world into them. So, when a superpower like the US gets directly involved in a war, understandably, we will feel anxious, not just about the global consequences, but as self-centered as it might sound, about how it could affect our investments. Now, I want to be clear, this is not to downplay the human tragedy of war, but when our fears take over, it can often drive us to make irrational decisions, especially with our money, and we can end up hurting ourselves in the long run. That's why I wanted to make this video to remind ourselves to stay calm and stay invested, even when the world feels uncertain. And here's a picture of a cute kitten, just to help you calm down a little. Now, I guess one of the biggest questions many investors are wondering now is, how will the war affect the stock market? As counterintuitive as it may sound, the markets have not only been incredibly resilient during wars, but have also gone up in general, even during the war itself. But here are some examples to see what I mean. In early 2003, just months before the Iraq War began, there was considerable uncertainty. Investors feared the worst, and markets tumbled as many rushed to pull their money out in anticipation for a global fallout. But remarkably, instead of crashing, the markets had begun to rally even before the invasion began. Within 2 months, the S&P 500 had fully recovered from its losses from earlier in the year, and by the end of 2003, it delivered a stunning return of nearly 36% from its bottom. Another example was the September 11 attacks in 2001. While it wasn't a war in the traditional sense, it was still a devastating act of terrorism that had an immediate and profound impact on the US financial markets. When that happened, the market was closed for about a week, and when it reopened, the S&P 500 fell by over 11% within 6 trading days, marking one of the worst weeks in market history. Yet, within 2 weeks, the market had recovered nearly all those losses. Now, you might think that these events were not severe or big enough to have any lasting damage to the market. So, let's take a look at the largest and most devastating conflict in human history, World War II. World War II was generally considered to have begun in September 1939, when Nazi Germany invaded Poland. Over the next 3 years, the Dow Jones fell by roughly 36%. But then, something unexpected happened. In the middle of the war, long before victory was assured or any clear outcome was in sight, the market bottomed and began to recover. And by the time the war ended in 1945, the Dow Jones had not only regained its losses, it actually ended slightly higher than where it was when the war began. Here's another example, the Cuban Missile Crisis in 1962, where the world came dangerously close to a nuclear war. And yet, during that period of extreme uncertainty, the S&P 500 only dipped by about 6% in 4 trading days. Then it recovered in just 10 days once the situation was resolved. Quick pause. If you are looking for the best brokers to kickstart your investing journey, check out Interactive Brokers. You will enjoy one of the lowest fees in the industry at just 35 cents per trade on the US stock market. It also offers Ireland domiciled ETFs, perfect for saving on dividend withholding taxes. Plus, it also comes with free company research tools, so you can make smarter investing decisions. Feel free to use my Interactive Brokers link to open an account and start investing today. Alright, let's get back to the video. In fact, when you plot some of the biggest market shock events since World War II, including wars, terrorist attacks and political crises, a clear pattern emerges. During these events, the market had a median decline of about 5.7% over the course of 15 days. After that, it only took the market a median of 16 days to recover, and after 12 months, the market went on to deliver an impressive median return of 13% from its bottom. The reason this happens is because markets don't fear war. Instead, they fear uncertainty and not knowing what comes next. Because of that, the market tends to do badly at the start of the conflict. And once that fear turns into reality, that uncertainty is gone. That's when the market turns its focus back on the economic and business fundamentals of growth and earnings. In fact, when you compare crashes that were caused by global conflicts and wars to crashes that occurred during peace times, such as financial bubbles bursting or the pandemic, the war-related declines would pale in comparison, while the peacetime crashes were a lot more severe. For example, the crash of 1929, which saw the market plunge by over 86%, and it took nearly 25 years or close to 300 months to fully recover. Then, in 1973, the oil shock combined with a global recession triggered a 48% market decline, with the recovery taking around 19 months. Meanwhile, the dot-com bubble burst in the early 2000s led to a nearly 49% drop in the S&P 500, and it took over 2 years for the market to fully recover from its losses. In other words, some of the most severe and prolonged market downturns didn't come during times of war. They happened during peacetime. They were either triggered by economic imbalances, speculation, or structural weaknesses that can directly affect the earnings of the businesses themselves. In contrast, markets have often shown surprising resilience during times of war and geopolitical crisis, recovering faster and falling less than what many would expect. But then, once the bombing of Iran triggered a wider escalation, initially right after the bombing, there were fears that Iran might shut down the Strait of Hormuz, a critical choke point through which about 20% of global oil and a third of the world's liquefied natural gas pass by. In fact, Goldman Sachs warned that if the strait were to be blocked, oil prices could surge past $100 per barrel. This would drive up the cost of energy-intensive goods like food, clothing, and chemicals. This could also cause higher inflation across the globe, slower economic growth, and in turn, central banks may be forced to delay or slow down their interest rate cuts. Thankfully, the likelihood of this happening is quite small, since China buys around 90% of the oil that Iran exports, and both China and Iran are pretty much on good terms with each other. So Iran closing the Strait of Hormuz would hurt China as badly as the rest of the world, something which Iran would very much like to avoid. Not to mention that if Iran did try to close off the strait, it would be met with strong response from the US and other Western navies patrolling the area. Interestingly, there have also been reports suggesting that Iran may have received advance notice before the strikes. This could explain why satellite images showed trucks lining up at the Fordo nuclear facility just days before the attack, leading to speculation that Iran was relocating its uranium stockpiles ahead of time. Similarly, Iran also gave early warning before launching missiles at a US base in Qatar, a move interpreted by many as a deliberate effort to avoid casualties. What this shows is that despite the intense rhetoric and dramatic headlines, both sides may be trying to manage tensions through a kind of controlled conflict. Basically, everyone wants to show the world that they are strong and yet at the same time want to prevent an all-out escalation, because the last thing that they need is the situation to spiral out of control. And sure enough, there are now reports that both sides have agreed to a ceasefire. That's why it is so hard to time your trades around a war, because one day the headlines could be screaming that the war is ending soon. Then the very next day, everything has been peacefully resolved. That's why the best investing strategy is still to stay invested no matter how bad the situation may seem. Here, we have two kinds of investors. One that only buys during market dips, and another that just consistently dollar cost average throughout. Logically, if you are able to buy during market dips, you will outperform someone that consistently DCAs. And this is indeed the case, especially if the dip occurs near the start of the time period. However, if we drag the timeline out, the higher likelihood that buying the dip will underperform a simple dollar cost average. This is because a dip doesn't usually happen all that often. However, even so, there's not much difference in return between buying the dip versus DCA. The real problem is when you try to stay out of the market, but end up missing out on the best days in the market. In this example, missing out on the 10 best days out of a 20-year period could cause you to miss out on over 50% of the returns. And the more days you miss, the lower returns you will get. And what makes this so difficult is that the best days in the market usually occurs right after the worst days, when everything seems dark and gloomy. That's why you should always stay invested no matter what. And of course, some of you might point out that, you sold Tesla near the bottom and the stock has rallied up. Well, so did the rest of my investments. And the difference now is that I'm more diversified, I can sleep better, and I have a much higher confidence in my portfolio than I've ever been. And besides, I'm still very much invested in Tesla through my ETFs, without having to deal with all the nonsense that comes with it. Anyway, that's all for this video. Hope you found it useful. Like, share and subscribe, as I'll be posting new videos every week.